Hi, my name's Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And before we jump into today's episode, I just wanted to thank everyone for their support. I've been overwhelmed by the support in terms of pre-ordering my book, and I thank you very much because it's really important. Bookstores, retailers and so forth will look at pre-order volume to determine whether they're going to stock the book, and there's no point writing a book if we can't get it into bookstores and people then can't buy it and read it. So I really do rely on this community to, help me get those books into bookstores. And the best way to do that is pre-orders. So thank you so much. If you haven't pre-ordered and you'd like to consider doing so, the link, including the pre-order bonus, is in the show notes. So you can certainly check that out. But thank you for those that have already done so. Okay, so let's get into today's episode. And this topic today, I've been thinking about really for most of the last 12 months, in that I always intended to do an episode on commercial property investing. And I've just been really thinking carefully on how to frame it and what I'd like to communicate. So it's been bubbling around in my head for a while. And so I'm excited to kind of share my thoughts with you. Over the last 5 years, probably the last 10 years, but particularly over the last 5 years, there's been an explosion of commercial buyers agents. So that is people out there that will espouse the benefits of investing in commercial property, and you can engage and then they'll go and buy a commercial property somewhere in Australia. Quite often, they won't be just looking in one state. They'll be doing cross-border transactions, which I think increases the risk because ultimately you're paying a buyer's agent for their experience and hopefully their experience within a particular locality. There's always nuance with property, and so I think it's important to have an expert in that particular location. But some of these buyer's agents will buy across the board, and they will post a lot on social media. I said all the time in terms of espousing their benefits, and there are some, real benefits of investing in commercial property. Higher rental yields, the tenant typically pays for most of the expenses, and there's potential for capital growth as well, although this is where, this is really the crux of today's episode. We'll talk and sort of uncover that a little bit more. The other thing that's happened and that's sort of forced the trend is compression in borrowing capacity. So obviously we've had credit tightening over the last 10 years, as well as then much higher interest rates. So on average over the last 3 years has really compressed borrowing capacity. So investors then start looking beyond residential property and look for alternatives. And in a way, they're reverse engineering it. They're sort of saying, what asset should I buy that's going to give me the greatest borrowing capacity, which isn't the right approach. It's really what asset should I buy that's going to help me achieve my goals? What asset can I buy that's going to give me the highest return for lowest risk? And borrowing capacity is an important element to that, but it's secondary. It's first, you've got to think about the quality of the property. And so really, I think investing in commercial property has its attractions and advantages, but it's only at the right price. So you've got to buy a property, a good quality property, for fair value in order to realistically expect decent future returns, not any property at any value. And again, this is the general theme of the podcast today. So as I said, one of the, I think, demand factors that are driving more investors towards commercial property is tenancy laws, tighter borrowing capacity, increases in holding costs. So things like for residential property, things like insurance, council rates, property management, compliance costs, they've changed a lot over the last sort of 5 years. Interest rates are a lot higher over the last 3 years, and then credit tightening as well. You put all those things together, it puts a lot of pressure on residential property investment from a cash flow perspective. And so a lot more investors have been turning their attention to commercial properties. These commercial properties tend to be in the $1 to $5 million range. I know that's a really large range, but just giving you a sort of general sense of what I'm talking about. Quite often the advertised rental yields are 5 to 6%. So that's sort of how much gross rental income that the tenant will be paying. In most situations, the tenant's going to pay most of the outgoings associated with the property. In most of these sort of situations where we're talking about a $1 to $5 million commercial property, you've got a single commercial tenant in there. And the property could be anything from an industrial shed to a retail shop, or it could be a more specialised property such as a childcare centre, fast food premises, medical suites, these sorts of things. In terms of locality, these sorts of properties in these price points tend to be located on the outskirts of capital cities or in regional cities and towns. So they're not in prime locations typically, because you'd need a lot more money for an asset that's going to be located in a prime location. Now, as I said, social media is awash of advertisements from commercial buyers agents saying, we bought this 5 years ago, or I just bought this and here's what the returns have been, or I bought this property today for this client, here's what we loved about the property and here's what we expect the returns will be. And of course they're all they're all impressive returns, and it makes for sort of good clickbait, I guess, and good advertising for them. But just want to be really careful about, I think, anyone that advertises returns. I mean, in this podcast, I've never said, you invest this way, you're going to get 10% per annum returns. I've talked about what the general market has done, but really what we can control is the way we invest. We've got to be very careful. Most professionals are very careful about setting return expectations. I mean, it's easy to set return expectations on a long-term basis. So, if we invest in this over the next 20 years, the average return should be between X and Y. I think that's relatively easy to do. But when we're talking about short-term returns, markets are influenced a lot by sentiment rather than fundamentals in the short term. So I think it's a bit of a red flag when any professional advisor starts really advertising returns very strongly. But also we have to think about the backdrop. So according to Knight Frank, industrial land values in Australia, particularly along the east coast, have increased between 46% and 131% over the last 5 years to mid last year. So I would put that's a quoted statistic from Knight Frank. I would say it's, as a general observation, and this is not going to include every situation, but generally industrial land values have doubled over the last 5 years. Buyer beware, because these sorts of assets don't double in land value. So industrial means like typically a shed, someone's going to operate a factory or use it for storage or operate their business from a sort of industrial shed, and they tend to be located in kind of industrial locations. And those properties have done really, really well over the last 5 years. So when buyers agents say, oh, look, I bought this, here's what the returns we expect, if they're just looking at the last 5 years, then of course the returns look attractive. But if those capital growth rates continue, those industrial properties will become unaffordable for both the investor and the person the business that's occupying it, which is a challenge. So normally what you see with industrial land values is they do increase, but certainly not at the pace over the last 5 years. But this is why it seems like an attractive substitute almost for residential property. So again, buyers agents and interested parties are sort of saying, look at commercial property, high yields, tenant pays all the outgoings, improves your borrowing capacity, and also there's this misnomer that there's no capital growth in commercial, but look at the past performance. And you put it all together, it looks like a very compelling investment opportunity. Again, what I want to do is unpack the evidence here to highlight what I see as the main risks in this asset class at the moment. Now, before we get into it, it's important to understand how commercial properties are valued, because it's very different to residential. Residential is really valued based on the underlying land value plus the value of the improvements. And there you go, that's what the value of a particular property is. And we would measure those two things by looking at comparable sales. With commercial properties are valued using capitalization rate or cap rate, and the cap rate reflects the income an investor expects to receive from a particular commercial property. So what sort of return is expected by investors, income return, by investing in a particular property? And of course, lower risk commercial properties obviously attract lower cap rates, and higher risk assets should also attract higher cap rates. And so a property leased to a blue chip tenant, let's say, CBA or NAB or Coles or, something, a blue chip, really large corporate, on a secure lease, long-term lease, would typically be seen as a lower risk asset, or a commercial property that has multiple tenants and all those tenants are blue chip, so it's got some income diversification, again looks a little bit lower risk than, say, a industrial shed lease to a startup. A startup company that doesn't have any runs on the board in a completely new category with a completely new product, something like that on a short lease, that's going to look a lot more risky compared to the blue chip tenant. And so that impacts the cap rates. The other thing that impacts cap rates is what investors want in terms of returns. So, which we'll get to, and we'll look at the long-term evidence in that regard. When we look at some data across 2025, across Sydney, Melbourne, and Brisbane, cap rates at the moment are around in the 5 to 6% range, which is pretty low. And there's been some pretty crazy sales during 25. So, for example, it's reported that a McDonald's sold in St Albans on a cap rate of 2.9%. And similarly in Sydney, a KFC sold on a cap rate of 3.2%. Both those cap rates are below the 10-year government bond rate, which is around 5% at the moment. So in other words, investors are accepting a lot less income return on the hope that they are going to achieve some capital growth. And it's possible. I'll get to, how a property can change in terms of its value. What are the contributors? And I'll get to that in a second. But it's possible those leases are linked to the turnover of those tenants. And if the purchaser, the landlord expects that the business is going to grow and the rent is linked to that growth, then maybe there is some upside. But it's a very low cap rate to pay. It's a very low, you need to earn significant capital growth, I think, or have a high level of confidence for that investment to be attractive. And sometimes when you see these sorts of sales, it is a bit of a red flag to say, what is going on in this market? Why are those cap rates so low? Maybe the market is over exuberant. The other thing we've got to think about when we look at these headline cap rates and yields is that they're gross. So that's before any expenses like things like buyer's agents fees, stamp duty, due diligence costs, legal fees. So there's transactional costs there that obviously the landlord needs to wear. Then we've got to deal with risk, potential vacancy. Normally, if there's vacancy within commercial properties, the vacancy period can be longer. Like it's not unusual for a commercial property to be vacant for 3 to 6 months, for example, between tenants. Then there's lease incentives. What sort of incentive do you need to provide to a new tenant to attract them? And then future capital expenditure in terms of maintaining the HVAC or the fire compliance, these sorts of things that, is the responsibility of the landlord. So once you factor those things in, which can sometimes end up being, 1% of the asset, then that can contract net yields down to 4 to 5%, for instance, if the gross yields are 5 to 6. So in this situation, it's important then to compare those sorts of yields to other income style assets, because commercial property has been historically viewed as more of an income style asset than a growth style asset like residential property. And look, people can argue over this a little bit, and particularly if you're going to cite sort of statistics from the last 5 to 10 years where, as I said, industrial land values have doubled over that period of time. Most recent data would suggest, okay, it's a growth asset, but in reality is more an income style asset. You might get capital growth of 3 to 4%, typically because lease terms tend to have fixed increments to keep up with CPI. So your lease income is going to increase by 3 to 4% per annum, and therefore that flows through holding the cap rate the same. That means the property value will increase 3 to 4%. So that's what the realistic expectation is in many situations. I'll talk about how the property value can change more than that later on today in today's episode, but that's a typical kind of expectation, if you like. So if we're saying commercial properties through 2025, we're selling between 5 and 6% gross. And if we say, well, once we factor in all the things I talked about, capital expenditure, vacancy, transactional costs, maybe those net yields are sort of closer to 4 to 5%. How does that compare to other income style assets? And again, it's important to make the comparison because we need to compare both risk and return. There's other income style assets that are lower risk And therefore, by comparison, then the return should be lower as well. So the first one that I'd look at is bonds from the banks. So the banks issue bonds, subordinated debt can be first ranking bonds and so forth. But you look at subordinated debt, which by the banks, they're A-rated bonds, which means the risk of default is extremely low. They're pretty safe assets. You'd almost sort of say they're riskless assets. The chance of default is extremely low. They're paying 5.75 to nearly 6.5%, somewhere in that range for what is a very low risk asset. Now you might go, yeah, sure, Stuart, it's not a really good comparison because you can't borrow to go and buy bonds unless you've got other security, whereas you can borrow 70% of a commercial property asset. I get that, but it's really important to separate those characteristics from the underlying return and quality of the assets. The first box you need to tick is, am I buying at an attractive price, and will the future returns be attractive? And then the next thing to think about is, how do I fund the asset? So quite often, unfortunately, assets are sold because they're saying, well, you can't borrow to buy a bond, you can't borrow to invest in equities like you can with direct property. Again, it's important to separate those two things. And what we're trying to do here is say, well, hang on, I'm going to get 4 to 5% income from a commercial property. Does that make sense when I can get 6% from a bank bond that has close to zero risk? You would say that by comparison, the commercial property is higher risk, but you're getting less of a return. Similarly, if I look at other investments, such as I'm aware of in fact, I know the person that runs this fund. It's called Castle Rock. It's a unlisted property trust. They hold several properties in the one trust. So you've got diversification, and all those properties are leased to government, either state or federal governments. So the tenants, of course, chance of default is really low. Currently, that fund's paying distributions around 8%, and not all of that, less than half of that is taxable. So it's very tax effective. And the whole portfolio on average is valued at a cap rate of 7.2%. So really what I'm sort of saying is you've got multiple properties across multiple jurisdictions providing a lot of diversification. 99% of it is occupied. It's all to secure government tenants. And I'm getting a 7.2% cap rate, which means that's my future expected return from an asset class and a portfolio that I would argue is really low risk and much lower risk than owning a $2 million commercial industrial shed, on the outskirts of a capital city or in a regional town or something like that. The sort of assets that I was describing previously. So you can start to see that it appears there's a bit of mispricing here. Well, I'd say it's stronger than that. It's not appearing there is mispricing. That these smaller style commercial property assets are selling for gross yields of 5 to 6%, but the yields should be much higher because they're not really compensating the investor for risk. And so why would I invest in them? I'm much better off going and taking virtually zero risk and putting my money in a bank bond and getting 6%, or putting in an asset like the Castle Rock Government Fund. If you want to check it out, there's a link on the blog on the website to that fund. And, pick up 8%, none of the hassle, 8% income, none of the hassle, and I'm getting in at, I think, a very attractive cap rate. So, as you know by now, I'm deeply attached to finding and looking at the evidence. So, I think, the first part of today's episode was sort of just setting the scene, looking at what prices are being paid for commercial property at this stage, or more recently over the last few years, comparing it to sort of other income style assets to sort of benchmark to see whether we're getting enough risk premium to cover the risk of doing so. And so that's taking us to where we are now, obviously realizing, no, it looks like that commercial property is a little overpriced. So I think then the next step is to really ask ourselves, what cap rates should we be seeing? Like, when is commercial property an attractive investment? And of course, I want to bury myself in the evidence. So let's go and have a look back over the last 40 years and see, where cap rates have been historically. So let's go back in time and have a look at where they've been. In the late 1990s, cap rates were relatively high. So for secondary industrial property, the sort of stuff that I'm talking about, the cap rates were 3.5 to 4.5% above the 10-year government bond rate. Now, the 10-year government bond rate is a proxy for the risk-free rate. That's what in financial markets, that's what they use as a benchmark for the risk-free rate, which means that's the return an investor should get without taking any risk. So that means in practical terms today, cap rates were 10 to 11 times. Now, in the 90s, early 90s, we had a recession. The commercial property market had a really challenging time through the late 80s as well. But you would say buying a commercial property asset on a cap rate of 10 to 11% is very, very attractive. But by the time we got to just before the global financial crisis, so we're really talking about mid 2000s here, cap rates were compressed substantially. So at the peak of that cycle, that commercial property cycle in early 2008, the cap rates were only about 1.5% above the 10-year bond rate. So in today's terms, that's 6.5%. So similar to what they are today, maybe slightly higher than what they are today. Then we had the GFC and cap rates expanded again. Ended up being by 2014 about 4 to 5.5% above the 10-year bond rate. So we're talking about sort of 9 to 10.5% in terms of cap rates. Again, buying an asset on a cap rate of 10% looks like an attractive proposition. And as the cycle continued, by the start of COVID, cap rates were compressed again. About 6 to 6.5% was the gross sort of cap rate. And with the bond rate between 5.5%, it means we're only getting a 1% risk premium. So over and above the risk-free rate, we're only being compensated by 1%, which is incredibly thin and a thinner margin than the boom before the global financial crisis. Now, we all know what happened at COVID. Interest rates almost went to zero in terms of the cash rate, and that further compressed commercial property cap rates as well. And so yields compressed to about 4.5% to 5%. And the government bond rate also was much lower at that time as well. Now, we know over the last 3 years, interest rates have risen a lot, but cap rates have not adjusted. And here's the thing to leave you with is that, yes, cap rates came down when interest rates went to zero during COVID, at the beginning of COVID. That kind of makes sense. And at that time, people were talking about, well, maybe interest rates will be zero for a long time. And people were looking at examples like Japan, who had zero interest rates for 20 years or more than 20 years now. And that was kind of the expectation. So there was a lot of pressure on cap rates. But really, over the last 3 years, the government bond rate, the 10-year government bond rate, has increased from about 1% to about 5%. But commercial cap rates haven't, so the government bond rate's up 4%, but commercial property rates between 22 and 24 and 25 have only risen by about 1.5% to 2%. So this is the main part of the story here, is that commercial property valuations or values look very stretched at the moment. And the reason they look stretched at the moment is because they haven't adjusted to accommodate the much higher interest rate settings that we're currently in. Now, when we have a look at what is the average cap rate you should expect, so when do commercial properties start to look attractive? Well, when you look over the last 30, 40 years, cap rates should be around about 3.5% to 4.5% above the 10-year government bond rate. So in real terms, or nominal terms, what we're really looking at is we want cap rates to be sort of 8 to 10%, somewhere in that range. That's when they start to look attractive. Now, remember that unlisted government property fund that I referred to, that's 7.2% at the moment. That makes sense that if I'm going to get 7.2% from something that's very diversified, very secure tenants, strong income profile, then compared to that, if I'm going to go out and buy a single commercial property for $2 million industrial shed on the outskirts of Melbourne, for instance, then I certainly want more than 7.2%. And so the range of looking at, say, 8 to 10% makes sense by that comparison. But instead of offering 8 to 10%, these small industrial sort of properties trading at cap rates of like 6 or 6.5%, which is way too low. They're just not offering enough return to compensate investors for the risk involved. So why haven't cap rates adjusted for higher interest rate settings? I think it's because demand has been unusually high in this sector. The first thing is that, as I mentioned earlier in today's episode, that higher interest rates, tighter borrowing capacity, increased holding costs, residential tenancy laws being tightened, all those sorts of things have, forced more investors out of residential property. And a lot of investors still like property, so they look for alternatives within the property space. And so those changes over the last 5 years, I think, has naturally pushed more people into that commercial property sector. And then added to that, obviously, the explosion of commercial buyers agents and, their advertising on social media, these sorts of things to try and generate more leads in that space, I think has artificially created a lot more demand. And that higher demand in this sector has compressed cap rates because obviously, there's more people bidding for these properties, and not all these investors, in fact, I think most of these investors don't understand what they're doing. They don't understand what the implications, which I'm about to talk through in a second, the implications of a reversion to the mean with cap rates, because it can be devastating for investors. So I don't think the fundamentals have changed. I think the fundamentals are the same. I think because of those things, artificially demand has changed. And will that demand persist? No, I don't think it will. And I think that a lot of investors are going to be hurt because they've bought commercial property almost at any price, not commercial property at an attractive price. Now, this is a good point to talk about, okay, how do commercial property values change? So if I'm going to buy a commercial property, how can I assess its potential of capital growth? And there can be a few different ways that a value of a commercial property can change, but there's typically really three. The first one is around the quality and quantum of rental income. So quality really refers to the tenant and the lease terms and conditions. So if I've got a blue chip tenant under a very long lease with many options in that lease, that to me starts to look like a secure income stream. The other thing can be how the income can change over time. So quite often commercial leases have fixed annual increments. So either they're fixed as a percentage amount. So 4% increases each year, for instance, or it can be linked to whatever CPI was within that period. Some retail leases, however, can be linked to turnover and growth and changes in turnover of the tenant. And you can see that, for example, with supermarkets, for instance. And so that's why sometimes people will pay really low cap rates, because if they believe that the tenant is going to thrive in that location and the rental income is linked to that sort of metric, such as turnover, then you can end up seeing increases in rental by, 6, 7, 10%. It's quite substantial. And so as the income, holding everything constant, as the gross income from a property increases, that directly affects its valuation, because that's obviously a component of the valuation. And so if my rental income is increasing by 10%, then holding everything constant, the value of my asset is going to increase by 10%. So that's the first element that can change the value of a commercial property. The second one is a change in underlying land value. So as I sort of said, industrial land values have doubled over the last 5 to 10 years in many locations around Australia. So if that underlying land value is changing, then of course by comparable sales, the value of my asset is changing. It could be that there's a higher productive use of land. So for example, if I've bought a commercial property in a location that's gentrifying and rezoning, and then if I can build, a block of apartments on that commercial property, it's happened a lot, say in suburbs like Collingwood and Fitzroy in Melbourne, then the underlying productive land value of that asset is much higher than its use as a commercial property. A similar example could be if I buy an industrial shed and there's a lot of vacant land around it, so it's a large block and there's space to increase and build more industrial sheds or expand the existing industrial shed. Well, that could be a way of manufacturing, more value, because you're really changing the income profile of the asset. So really it's underlying land value. The third factor is a change in capitalization rate. So if capitalization rates are really low low like they are today and they increase, then values fall. But if capitalization rates compress, then values rise. So a change, that's why when you enter and the price you pay for a commercial property is probably one of the largest determinants of your future return. And that's really the whole theme of today's episode. Okay, I wanted to ask what would happen if we experience some mean reversions. As I said, cap rates are 6 to 6.5% at the moment. They probably should be between 8 and 10%. So if I go and buy a $1.5 million commercial property, I go and borrow 70%. So I contribute the remaining amount as cash contribution. What happens if cap rates revert to the mean? So if cap rates go from 6.5 to say 8%, my commercial property is no longer worth $1.5 million. It's worth $1.2 million. So I've lost $300,000, or about more than 60% of the equity that I put into that asset. If cap rates go to over 9%, I virtually wipe out all my equity because the asset is now worth maybe about $1 million and I've lost $500,000. That's why cap rates and buying a good quality asset at a attractive price is the most important thing to do if you're going to generate good returns from commercial property investing. I've got a table, there's a bit of maths involved here. So I've got a table on the website in the blog on the website that, of course, the link is in the show notes as always, that you can look at that shows, how mean reversion on cap rates impacts an investor's equity position. Now, I think the biggest risk is that, the proposed changes to negative gearing or quarantining negative gearing for established assets, this could add further fuel to the fire. So I can just imagine now that if those changes become law, those buyers agents are going to become commercial property buyers agents are going to become very, very active online and heavily promoting commercial property. And I think that's probably going to compress cap rates even further. So commercial property valuations look very stretched today. I anticipate, unfortunately, more investors are probably going to move into that space and they're going to look even more stretched. Now, that just means that there'll probably be some increases in values over the next few years. So those that got in, say, 5 years ago are going to really enjoy that ride. You might want to think about, whether you exit that investment if you believe what I'm saying, that asset is intrinsically overvalued. So I think in the short term, this trend is going to persist, but the lower cap rates go, the more risky the investment proposition is. So I guess in summary, commercial property certainly has its advantages, higher income profile, tenant pays for a lot of outgoings, these sorts of things, but it's not commercial property any price. It's really commercial property at the right price. And that's true for any asset class, whether we're investing in shares, residential property, really any asset class. We've got to have what I would refer to as a value aware asset allocation, and is in fact, here's a shameless plug, a new chapter in my new book, Wealth by Design, where I talk about how to construct a value aware asset allocation. So I don't like commercial property at this stage. I think the values are just too high. The cap rates are way too low relative to the risk associated with investing in commercial property. That's not to say I'd never invest in commercial property. I absolutely would, and I have. My wife and I have personally, but it's got to be at the right price and the right time. As I said at the beginning of today's episode, thanks for those that have pre-ordered my new book, Wealth by Design. Just a quick reminder, link is in the show notes to pre-order that book and get the pre-order bonus. I'll leave it there today. Until next week, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.